This is Nightly Business Report with Tyler Matheson and Sue Herrera.
iPhone sales surge, and that's exactly what investors wanted to see in Apple's results, sending shares initially higher.
Not your corner pharmacy. Late news tonight. Two of the nation's largest drugstore chains will merge.
Turn up the heat as the temperature drops because this winter it may not cost as much. All that and more tonight on Nightly Business Report for Tuesday, October 27th.
Good evening, everyone, and welcome. Apple may be asking what global slowdown? The world's most valuable company reported strong demand for iPhones over in China and a sharp rise in profits and revenue overall. For the quarter, the Dow component earned $1.96 a share, and that was 8 cents better than expectations. Revenue also beat estimates. It climbed 22% from just a year ago, and that sent shares of the widely held company in mutual funds and retirement accounts, among other places, initially higher in extended trading. Our Josh Lipton has more on Apple's quarterly results.
48 million. That was the big number in Apple's latest earnings report. That's the number of iPhones that Apple shipped in the quarter, and that was up 22% year over year. It was in line with what Wall Street had forecast. Remember, we can talk about Apple Pay or Apple Music, but at the end of the day, this is an iPhone company. It is the iPhone that generates the bulk of this company's sales. Some investors and certainly some analysts on Wall Street concerned about whether Apple can meaningfully grow iPhone units in the quarters ahead. A maturing smartphone market, a slowing China, and certainly tough comps. I did, though, have the chance to speak to Apple's CEO Tim Cook. He remains confident. He notes that more people than ever are switching over from Google's Android, and he notes that 70% of the install base is on that iPhone 5S or earlier, and that implies a lot of potential upgrade headroom. For Nightly Business Report, I'm Josh Lipton in Cupertino, California.
So let's turn now to our guest, David Garrity, to talk more about what lies ahead for Apple and what it may mean for you and your money. He is principal of his own tech firm, GVA Research. Good to see you, David. Welcome.
Good to see you. Sue, thank you very much.
So let's talk about this report. Were you as impressed as those who traded the stock in after hours were?
Well, certainly we'd had, a lot of investor concern about China going into the quarter's report. And if you look at China, revenues from China are about 24% of the total company's revenues, compared with less than 14% a year ago. Looked on a percentage basis, China revenues were up year over year by about 114%. So obviously that was a major driver for the 22% revenue gain. Certainly you have to look at China and say that, fine, revenues might have been down quarter over quarter by 5%, but we're still in a situation for Apple globally that China is going to be a very significant geography to them. And we think that with the holiday shopping season coming up over the next 2 quarters, obviously in the December quarter here in the Western Hemisphere, but obviously the Lunar New Year falls in the first quarter of next year, we think that Apple's got a good 6 months in front of them.
Some of the nitpickers found this nit to pick, and that was that the guidance for the upcoming quarter to some lights was a little softer than they had hoped. But is this just Apple being Apple and setting the bar at a level where they're comfortable that they can meet or exceed it?
I think Apple has always shown a very strong pattern of basically trying to lower expectations after they release a quarter. So from that standpoint, Apple is being consistent with their historical pattern. There is a debate, though, that investors have, and that certainly is to what extent do we think that Apple has saturated the high end of the smartphone market. One would argue, though, there's still a very, very large market out there. As was mentioned earlier, you still have a substantial base of Apple iPhones that are out there that have not yet upgraded to the 6 or the 6S. And from that standpoint, there's significant pent-up demand in our view.
The comments about the Apple Watch were encouraging as well, weren't they, David? Talk to me about some of the other products other than the iPhones.
Yes, in terms of the Apple Watch, we're in a position right now going into the year-end holiday shopping season where we think that the Apple Watch is going to be an important gift for people to consider. And this is something that's slowly going to build up over time. We don't necessarily have expectations for the Apple Watch to ramp as rapidly as we're seeing with the iPhone. Certainly, Apple's sensitive to the competition in the market, so they're not breaking out the Apple Watch results separately. But we do think that it's going to be an important driver. We would also look near term for Apple TV. They've come out with the new version of their set-top box, which is going to be offering far more content and far more access to the App Store off of people's televisions.
Very quickly, where do you see the stock in a year?
$150 over the next 12 months. We think that also we're going to see nice gains in terms of dividends and buybacks.
All right, David, thank you for joining us tonight. David Garrity with GVA Research.
Thank you.
Shares of the Dow components Pfizer and Merck rose today on better than expected profits. Both companies were helped by growing sales of expensive drugs, including new cancer medicines, and both raised their profit forecast. Shares of Pfizer, the world's second largest drug maker, rose almost 2.5%. Merck, which also benefited from cost cuts last quarter, it saw gains of 1%.
Fellow Dow component DuPont saw its sales and earnings drop in the third quarter. The strong dollar and weak agricultural demand in emerging markets contributed to the decline in profits. But the interim CEO said he was considering potential deals in the ag industry. The stock, however, climbed more than 2.5%.
IBM said the SEC is investigating the way it accounts for certain revenue from transactions in the U.S., U.K., and Ireland. IBM says it learned of the investigation in August, but disclosed it today in a required regulatory filing. IBM says it is cooperating fully with the regulators. The disclosure sent shares of Big Blue down 4%. Didn't need that. Separately, the company's board has approved a $4 billion share buyback.
Well, IBM shares weighed on the blue chip Dow index along with some disappointing economic data just one day ahead of a policy statement from the Federal Reserve. The Dow Jones Industrial Average fell 41 points to 17,581. The Nasdaq dropped 4 and the S&P 500 was off 5 points.
In merger news, Walgreen Boots Alliance will buy Rite Aid. The deal, which was confirmed after the closing bell, is valued at around $17 billion, a huge premium for that stock. It would combine two of the nation's largest drugstore chains. There was speculation an agreement was close during the day, and that sent shares of Rite Aid up 42%. But that's before the deal was consummated. Walgreen up 6%, and as Bob Pisani explains, there are reasons why this tie-up makes sense.
This is all about cost savings. The Affordable Care Act is putting pressure on pharmaceutical companies and the retail drugstore chains to keep drug costs down. So if you're a Walgreens or a Rite Aid or a CVS, you want to get bigger so you can have lower administrative costs and also be in a better negotiating position against the pharmacy benefit managers that sell you all those drugs. Okay, what about antitrust issues? The deal will certainly be scrutinized by regulators, but Rite Aid is much smaller than Walgreens or CVS, and it only has a large presence in a few regions like the Northeast. So there is speculation the deal might be able to go through with Walgreens selling only a small amount of Rite Aid stores. One analyst estimates that Walgreens would only have to divest about 10% of the acquired Rite Aid outlets. And remember, the retail drugstore business has a lot of competition. Everyone from Walmart to Target to Kroger, even the small local grocery stores are in this game. So that greatly diminishes the chances that antitrust alone would blow up the deal. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Starwood is reportedly being pursued by Chinese buyers. According to the Wall Street Journal, 3 Chinese companies have submitted proposals to Beijing. The Chinese government is expected to select a bidder in the next few weeks. Such a deal would likely be the largest ever Chinese takeover of a U.S. company. Shares of Starwood rose 9%.
Now to the economy. Consumer confidence fell in October, in part because Americans were feeling less optimistic about their job prospects. Separately, orders for long-lasting manufactured goods, so-called durable goods, dropped 1.2% in September, following a 3% decline in August. And within the durable goods report was a key gauge of business investment. It fell for a second consecutive month.
The price of homes went up in August. The S&P Case-Shiller Home Price Index rose a little more than 4.5%. That was greater than July's increase. San Francisco and Denver saw the biggest gains, both up double digits.
The data-dependent Federal Reserve is taking note of the incoming economic reports. The central bank began a 2-day policy meeting today. It will release its statement tomorrow. But as Steve Leisman reports, many expect the Fed will wait a bit more before raising interest rates.
A slowdown in hiring, weaker overall economic growth. They've combined to convince Wall Street the Fed won't hike rates at this week's meeting, and maybe not even this year. The CNBC Fed survey finds that the median of the 41 respondents, who include economists, analysts, and fund managers, see the Fed hiking in December. That's 3 months later than the last survey.
My guess is the reason the Fed won't raise rates this year is the job market's decelerating. I expect job growth to remain on the relatively soft side through the rest of this year. And at the same time, I don't see much inflation pressures developing.
But the group is split. About half see a hike this year, the other half next year, or even 2017.
If they didn't find reason to do it in September when they had this great opportunity to do so, I don't see how they're going to rationalize doing it tomorrow or even in December, because not much is going to change.
The weak economic data has made Wall Street more worried about recession. The chance of a downturn in the next 12 months rose for the fourth time in a row. The measure is the highest it's been in 2 years, since the nation last struggled with a debate over a government shutdown.
There is a rising chance of recession, but the base case still is an economy that's limping along at roughly a 2% pace. But the second half of this year, growth will probably be a bit under that, and that's the reason why the Fed's not going.
All the on-again, off-again talk of a rate hike has many on Wall Street criticizing the new Fed chair. The survey shows Janet Yellen gets an overall grade of just C+, a full grade below her mark 6 months ago. For Nightly Business Report, I'm Steve Leisman.
Still ahead, the new face of blue-collar America and why the manufacturing sector is still struggling to create jobs.
Oil prices slid to a 2-month low today, but crude isn't the only thing that's sliding. The price of natural gas is falling as well, dropping about 15% in the past week alone. And if the trend continues, as some say it will, that could mean lower heating bills for many this winter. Jackie DeAngelis has more.
Natural gas prices hitting a 3-year low this week as warmer than normal temperatures spooked the market ahead of Halloween. In the case of nat gas, it's a classic supply-demand story. Not only are total inventories nearly 14% higher than they were last year at this time, that's according to Platts, but expectations for soft demand are leading some analysts to believe that we could see prices fall to levels not seen in more than a decade. Why weaker demand? Well, U.S. weather models are calling for temperatures to remain above normal in the Northeast and the Midwest, both key regions for usage. El Nino is being cited as a reason. As prices fall, consumers are hoping their heating bills will, too. More than 50% of U.S. homes run on nat gas, and it supplies more than 20% of energy needs overall in the United States.
The trend is clearly downward. The weather continues to be extraordinarily good. We're probably going to be 1 or 2 or 3 degrees warmer this year than last year. And if that happens, as long as there's no shutdown continuing in production, you might, just to do it, put a 1 handle up on nat gas. That's hard to believe, but we might well get there.
For homeowners using heating oil, warmer weather could help as well. Prices are down more than 5% in a month. Propane prices down 12% in the same time period. But buyer beware. When futures prices drop, there typically is a lag effect before we see heating bills drop. And the last time that nat gas was under $2, that was 2012. It was the 4th warmest recorded winter in history. Still, Mother Nature could throw us a curveball, and if she does, all bets are off. For Nightly Business Report, I'm Jackie DeAngelis.
In Washington, the House of Representatives passed a highway and railway safety bill. The measure will fund road and bridge construction projects into late November, and it gives the House more time to work on a longer-term bill. It also extends a key rail safety deadline to the end of 2018. The measure now heads to the Senate.
And a tentative budget deal has been reached in Washington, but not everyone is praising it, not by a long shot, or praising the process, not even the current Speaker of the House.
I'm in full agreement. It stinks. This is not the way to run a railroad. But when you've got a situation that we're dealing with today, it's like it wasn't any choice.
Last night, we told you a deal was near, and tonight we can tell you that the agreement increases federal spending by $80 billion over 2 years and raises the federal borrowing limit through 2017. Ed Mills, senior financial policy analyst at FBR Capital, joins us now with his analysis of what is happening in Washington. You know, Mr. Mills, there's so much to cover here. It sounds like not anybody is really very happy with that, which may mean, as the speaker just said, it's the best deal that they can come up with. Will it pass?
This bill is going to pass, and it's because there's something in it for everyone. Democrats do not want to kind of change speakers unless the debt limit's increased. Republicans have the talking point that, you know, Obama didn't want to negotiate with the debt limit, but he did, and we're able to see some entitlement reforms for the first time since Reagan was in the White House.
So what do you anticipate that there will be any pushback?
Oh, absolutely. I mean, members of the Freedom Caucus voting against this. Maybe even a majority of the House Republicans vote against this, but all you need is about 30, 40 Republicans to come on board with the vast majority of Democrats in the House, and it gets sent over to the Senate. In the Senate, they have a different problem. There's a lot of Republicans in blue states who don't want to have this brinksmanship for the next 2 years, and they'll very willingly kind of have a filibuster-proof majority in the Senate by the end of the week.
Let's talk a little bit. We talked about the overall parameters of the deal. I want to zero in on two things that are part of this deal. One is of high interest to seniors, and that is the matter of rising Medicare premiums that were expected for some to go up 52%. Does this solve that one, and does it solve the questions about the disability payments under Social Security?
Absolutely. So under this bill, it doesn't completely solve those Medicare increases, but it does cap that increase at about 20% rather than 50+%. And then on Social Security disability, this was something that the trust fund didn't have a lot of news, but this trust fund was going to go bankrupt next year. So instead of having a fiscal fight over that and another fiscal cliff, what they've done is rework some of the formulas and added some fraud prevention provisions in here to make sure that the people who are on disability who should not be on disability are more audited and kicked off, making sure this fund will have this funds to stay on for years to come.
All right, Ed, thank you very much for your insights tonight. Ed Mills with FBR Capital Markets.
Light guidance weighs on shares of Twitter, and that's where we begin tonight's market focus. The social media firm reported slower user growth and gave a disappointing revenue forecast. This is Twitter's first earnings report with Jack Dorsey as its permanent CEO. Shares tumbled in initial after-hours trading. During the regular session, the stock was up 1.5% to $31.34. Ford reported earnings that missed estimates. The automaker's revenue topped forecasts, and the company's North American unit had its best quarter ever. The company's chief financial officer says he doesn't see that slowing down anytime soon.
For growing the top line, we're growing the bottom line. The cash generation, that was also a record in the quarter. It's very positive. And in the U.S., which is critical for us and for many in the industry, we don't see any signs whatsoever that the industry is going to be slacking off at all from the very high levels that it's at.
Nonetheless, shares tumbled 5% to $14.89. UPS reported earnings that topped consensus, even though its revenue dipped in its most recent quarter. The package delivery giant also says it expects holiday season deliveries to rise at least 10% from a year ago. The stock fell nearly 3% to $103.10. And JetBlue saw earnings rise in its third quarter, helped by lower fuel costs. Also, charging for checked bags bolstered the company's bottom line. Still, revenue came in just below consensus. Shares slipped 3% to $25.36.
And Coach also came out with some mixed results. The handbag maker's revenue was shy of analyst estimates, but sales declines, but at the lowest pace in over 2 years as demand in North America rebounded. So some bright news there. Shares up today, almost 4.5% to $31.65. Bristol-Myers Squibb saw its shares rise after it posted a beat on both the top and bottom lines. It also hiked its full-year guidance as one of its cancer treatments helped performance there. Shares up 3.5% to $66.80. Cummins slashing up to 2,000 jobs, or nearly 4% of its workforce. It is attributing the move to weaker demand for its engines, and if you're an engine maker, weaker demand is not a good thing. It also cut its revenue outlook for the year. Shares off nearly 9% today to $102.35.
Tomorrow night in Boulder, Colorado, the Republican Party will hold its third presidential debate. This one will focus on the economy. We will likely hear every candidate talk about creating more jobs, especially manufacturing jobs. But as Phil LeBeau reports from Colorado Springs, getting millions of jobs back on the shop floors is a promise few politicians have fulfilled.
technology.
Candidates love talking about creating more blue-collar jobs. Jim James has heard it for years. He runs Ideal Industries, which employs almost 2,000 people making tools at 16 U.S. plants. He says to manufacture in America, you have to compete globally.
Our customers can only afford so much to pay for certain products. And if we can't get our costs in line, then, you got to go where you can get your costs in line. So unless our products can differentiate greater than what's coming in from offshore, we're going to always be at a disadvantage.
So Ideal has to do more with fewer workers. In fact, the company is laying off up to 150 employees at this plant in Colorado Springs, while investing in automation and, in some cases, robotics. This is the new face of blue-collar America, leaner, smarter, with more skilled workers. Factors that explain why President Obama is falling way short of his promise to create 1 million manufacturing jobs in his second term.
It's been a real struggle to bring even more people into this industry. And I think to focus on that as your crux of judging the health of an industry is a mistake.
Still, candidates like Donald Trump keep making big promises.
I'll bring back our jobs from China, from Mexico, from Japan, from so many places. I'll bring back our jobs and I'll bring back our money.
Jim James is skeptical.
I think it's really hard to think you can force people back here and still be able to get somebody to buy your product at a higher cost. It really comes down to, can your customers afford the price of your product? That's really what it comes down to.
James is optimistic the jobs being cut at this plant here in Colorado may eventually return once the company invests in new technology, which will allow Ideal Industries to be more competitive globally. He says those investments, not political promises, are the key to growing manufacturing jobs in the future. Phil LeBeau, Nightly Business Report, Colorado Springs.
Northrop Grumman has won a $60 billion Air Force contract to build bombers. This ends a 4-year-long competition between Northrop, Boeing, and Lockheed Martin. Shares rose initially after the close on that news.
And coming up, will Microsoft's new video game release be enough to power up its lead against rival Sony?
Here's a look at what to watch for tomorrow. The Federal Reserve will deliver its post-meeting statement. Anheuser-Busch InBev and SAB Miller have until tomorrow to complete their discussions on a potential merger, which would be the biggest beer deal ever. And House Republicans will vote on a House Speaker to replace John Boehner. And that's what to watch on Wednesday.
A new study shows that families spend a lot more caring for dementia patients at the end of life than other diseases, such as cancer or heart disease. According to research published in the Annals of Internal Medicine, average out-of-pocket spending for dementia patients was 81% higher than it was for those with other diseases.
Microsoft is launching the latest installment of its biggest video game franchise, and it may turn out to be a key part of the company's strategy to compete with Sony's PlayStation. Julia Borston has our story.
Contact. Halo is Microsoft's most valuable game franchise by a long shot, generating $4.6 billion in sales for the tech giant. And Halo 5 Guardians is particularly important, and not just because it cost a reported $100 million to produce. Halo, which is exclusive to Microsoft's Xbox, is considered a key way to help the tech giant recoup its investment in the Xbox One, which is lagging its rival, Sony's PlayStation 4. Xbox chief Phil Spencer says Microsoft knows consumers carefully evaluate a console's exclusive games, and Halo is Microsoft's biggest exclusive.
It's critical to Xbox's success that Halo is successful. They're a very symbiotic relationship between Xbox and Halo's success and the success on Xbox Live. I'm really encouraged by the early signs that this is going to do well for us.
But Microsoft faces plenty of competition. Sony's PlayStation 4 has outsold the Xbox One by nearly 2-to-1, and Halo is up against an even bigger franchise. Activision's Blizzard's Call of Duty games have sold over $11 billion at retail. Activision's next installment, Call of Duty Black Ops 3, launches a week from Friday. It has the advantage of selling versions for both major consoles. Still, Xbox's Spencer says he's not concerned about the competition.
It's really a great time in the game industry. You see Sony having great success with their console. We're selling more Xbox Ones than we've ever sold of any previous Xbox at this point in the generation. We've got more players on Xbox Live, and it's just a really healthy time in the game industry, and I think the success of many of the companies shows that.
People certainly seemed excited at midnight events at stores around the world and the 6-hour YouTube stream last night. Reviews have been positive, particularly of a new 24-player mode. We'll see how that helps it stick out from its competition this crowded holiday shopping season. For Nightly Business Report, I'm Julia Borston in Los Angeles.
There will be no promotions, no doorbusters, no waiting in line at outdoor retailer REI on Black Friday. The store will be closed on one of the year's biggest shopping days, and the company is encouraging would-be shoppers to spend the day outside. REI also says it will pay its 12,000 employees for the day, even though they're not working. This makes me like them even more.
I think so. I think so. They're true to their mantra of being outdoors and communing with nature. That does it for us on Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Matheson. Have a great evening, everybody. We'll see you tomorrow.